Picture yourself standing at the edge of your financial future, watching your hard-earned money grow or slip away. That's exactly where millions of investors find themselves every single day. But here's the thing, the difference between building lasting wealth and watching it vanish often comes down to avoiding 7 critical mistakes that I'm about to share with you. And trust me, what you're about to learn could revolutionize the way you think about investing forever. You see, every single day I watch smart, capable people make these same mistakes over and over again. They're not making these errors because they're not intelligent. In fact, sometimes being too smart can be part of the problem. They're making these mistakes because nobody ever taught them the truth about what really drives successful investing. Before we continue, if you are curious about the millionaire mindset habits, you can access the video in the cards section. Let's dive into mistake number 1, emotional investing. You know that feeling when the market plunges and your heart starts racing? When your palms get sweaty as you watch your portfolio drop 20% in a week? That's your emotions trying to hijack your financial future. Studies show that emotional investors earn a shocking 50% less than those who stick to their strategy. Think about that. Letting your emotions control your investing decisions could literally cost you half of your potential wealth. But here's the solution that's changed countless investors' lives. Create an investment constitution. This isn't just any ordinary document. It's your personal blueprint for wealth building. Write down your strategy, your goals, and most importantly, your rules for buying and selling. When emotions run high, this becomes your anchor to rational decision making. It's like having a wise version of yourself from the past, guiding you through turbulent times. The data backs this up dramatically. During the 2020 market crash, investors who followed their pre-written investment plans outperformed panic sellers by an astounding 37%. That's the difference between turning $100,000 into $137,000 versus watching it shrink to $73,000. Your investment constitution becomes your lighthouse in the storm, guiding you safely to shore while others get swept away by emotional waves. Now, let's tackle mistake number 2, and this one's a silent wealth killer: market timing. We've all been there, watching the markets, waiting for that perfect moment to invest. Maybe you're holding cash right now, thinking you'll invest when the market settles down or hits bottom. But here's the devastating truth that Wall Street doesn't want you to know. Even the most sophisticated institutional investors fail at timing the market consistently. The numbers are staggering. Research from JP Morgan shows that if you missed just the 10 best trading days over the past 20 years, your overall returns would be cut nearly in half. Think about that. Just 10 days out of thousands could determine whether you retire in comfort or struggle to make ends meet. And here's the kicker: 6 of those 10 best days typically occur within 2 weeks of the 10 worst days. So when your instincts are screaming at you to sell, that's often exactly when you should be buying. The solution: dollar cost averaging, your new best friend in wealth building. Instead of trying to outsmart the market, invest a fixed amount regularly, regardless of market conditions. It's like putting your wealth building on autopilot. This strategy has consistently outperformed lump sum timing attempts by 23% over 5-year periods. When you dollar cost average, you're essentially buying more shares when prices are low and fewer shares when prices are high, automatically doing what every investor dreams of: buying low and selling high. But here's where these first 2 mistakes intersect in a way that most people never realize, and it's crucial to understanding why so many investors struggle to build real wealth. You see, emotional investing and market timing are actually 2 sides of the same coin, and when you combine them, they create a perfect storm that can devastate your financial future. The good news? Once you understand this connection, you can turn these common mistakes into your greatest advantages. Speaking of advantages, this brings us to mistake number 3: under diversification. You've heard the saying, don't put all your eggs in one basket, but what you might not know is that 68% of new investors concentrate more than half their portfolio in a single sector. It's like building a skyscraper on a foundation of toothpicks. One strong wind could bring everything crashing down. Let me share something shocking. A recent study found that investors who concentrated their portfolios in their favorite sectors underperformed diversified portfolios by an average of 32% over 5 years. Think about that. Betting everything on what you think you know could cost you 1/3 of your potential wealth. But proper diversification isn't just about owning different stocks. It's about building an investment ecosystem. The solution: the pyramid strategy. Picture your portfolio as a pyramid. At the base, you have broad market index funds providing stable foundation. The middle layer consists of diversified sector ETFs that align with major economic trends. The top, that's where you can place your more strategic, concentrated bets, but never more than 10% of your total portfolio. This strategy has shown to reduce portfolio volatility by up to 45% while maintaining strong growth potential. Now, let's tackle mistake number 4, and this one's particularly deadly because it feels so right. Chasing performance. We've all done it. You see a stock that's skyrocketed 300% in 6 months, and suddenly FOMO kicks in. You think, if I don't buy now, I'll miss out on the next big thing. But here's the cold, hard truth. Studies show that 93% of stocks that experience explosive growth significantly underperform in the following 3 years. The solution? Implement the reverse momentum strategy. Instead of chasing what's hot, look for solid companies in temporarily underperforming sectors. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. This contrarian approach has historically generated returns that outperform trend followers by 27% over market cycles. Here's a powerful example. During the tech bubble of the late 1990s, investors who chased high-flying tech stocks saw their portfolios crash by up to 80% when the bubble burst. Meanwhile, those who maintained balanced portfolios and systematically rebalanced actually profited from the volatility. But here's what's truly fascinating about these next 2 mistakes we're about to discuss. Speaking of profiting from volatility, let's tackle mistake number 5: neglecting fees. Those tiny percentages might seem harmless. After all, what's the difference between a 1% and 2% management fee? But here's the shocking truth: that 1% difference could cost you over $500,000 over a 30-year investment period. It's like having an invisible hole in your investment bucket, slowly draining away your future wealth. The math is staggering. On a $100,000 portfolio growing at 8% annually, a 2% fee will cost you $933,000 in lost returns over 30 years. That's not a typo. You're literally giving away nearly $1 million in potential wealth. The solution? Implement the zero-drag portfolio strategy. Start by auditing every single fee in your investment ecosystem: management fees, trading costs, administrative charges, and hidden expenses. Replace high-cost mutual funds with low-cost index ETFs. A typical actively managed fund charges 1.5% while delivering virtually the same performance as an index fund charging 0.05%. That's 30 times less expensive. Studies show that low-cost index funds outperform 92% of actively managed funds over a 15-year period. Why? Because those fees compound against you just as surely as interest compounds for you. Here's an advanced tip that most investors miss. Look for negative cost investing opportunities. Some brokers now offer cash incentives for maintaining certain balance levels or using their trading platforms. By strategically combining these offers with zero-fee ETFs, you can actually get paid to invest rather than paying fees. This connects directly to mistake number 6, playing it too safe. You might think keeping your money in safe investments like savings accounts or bonds is protecting your wealth. But here's the terrifying reality. With inflation averaging 3% historically, your safe money is actually losing purchasing power every single year. In fact, keeping $100,000 in a savings account earning 0.5% means losing over $30,000 in real purchasing power over just 10 years. The solution? The strategic risk pyramid. Instead of avoiding risk entirely, categorize your investments into 3 risk tiers. The foundation layer, 50% of your portfolio, focuses on wealth preservation with inflation-protected securities and blue-chip dividend stocks. The middle layer, 30%, targets growth through broad market index funds. The top layer, 20%, pursues aggressive growth through carefully selected individual stocks or specialized ETFs. What makes this strategy truly powerful is how it prepares you for the 7th and most devastating mistake of all: not starting soon enough. This isn't just about lost time, it's about lost potential. Every single day you wait to start investing is costing you exponentially more than you realize. Let me show you the shocking math. Starting just 5 years later can reduce your final portfolio value by over 50%. That's right, waiting just 5 years could literally cost you half of your potential wealth. Consider this mind-blowing example. 2 investors, both investing $500 monthly until age 65. The first starts at 25, the second at 30. Assuming an 8% average annual return, the 5-year head start results in a difference of over $600,000 in their final portfolio values. That's the price of a luxury home, lost simply because of a 5-year delay. But here's where it gets even more interesting. The power of compound interest creates what I call the wealth acceleration curve. The earlier you start, the steeper this curve becomes. In fact, every dollar you invest in your 20s is worth $10 invested in your 40s, assuming the same rate of return. This is why the most successful investors don't just start early, they start with intensity. The solution? Implement what I call the time arbitrage strategy. Instead of waiting until you have enough money to invest, start with whatever amount you can right now. Even $50 a month invested consistently will outperform larger amounts invested later. But here's the crucial part. Combine this with an automatic escalation plan. Increase your investment amount by just 1% of your income every 3 months. This creates a behavioral hack that bypasses your brain's natural resistance to saving more. Let me share a powerful secret that ties all these mistakes together. The powerful secret that connects all these investing mistakes? They're not really mistakes at all. They're opportunities in disguise. Every single one of these common pitfalls has a hidden silver lining that can actually accelerate your wealth-building journey, but only if you know how to harness it. Remember those emotional decisions we talked about? That same emotional awareness can help you spot market extremes. The urge to time the market? It can be transformed into strategic rebalancing. Under diversification, it teaches you the importance of deep research. Performance chasing. It helps you identify emerging trends early. Fee negligence? It forces you to become more conscious of value. Playing it too safe? It builds risk management skills. And starting late? It motivates you to be more aggressive with your savings rate. But here's the game-changing insight that will transform your investing journey forever. These 7 mistakes form what I call the wealth-building matrix. Each mistake corrected doesn't just eliminate a problem, it creates a competitive advantage. When you master emotional control, you can buy when others panic. When you understand market timing's futility, you develop unwavering consistency. When you embrace true diversification, you become anti-fragile to market shocks. The real question isn't whether you'll make these mistakes. Everyone does. The question is, how quickly will you learn from them? Every successful investor I've ever met has made all of these mistakes. The difference? They used each mistake as a stepping stone rather than a stumbling block. So here's your action plan. Start by conducting a portfolio audit using the strategies we've discussed. Score yourself on each of these 7 areas. Where are you making these mistakes right now? Then, implement one correction at a time, starting with whatever's costing you the most money. Remember, you don't have to be perfect. You just need to be slightly better than you were yesterday. Your journey to financial freedom starts with turning these common mistakes into your unique advantages. Don't forget to hit that subscribe button and join our community of smart investors. Together, we're building wealth the right way, one decision at a time. See you in the next videos, where we'll dive even deeper into building your financial empire.